Thank you, President Musalem. As Alberto mentioned, this conference is sponsored by the Federal Reserve System, the Conference of State Bank Supervisors, and the Federal Deposit Insurance Corporation. And you will hear from representatives from the three sponsoring agencies throughout this program. And certainly, I am grateful to the work of all of the sponsors on our planning committee as well. So just to continue that theme of hearing from our sponsors, I am now pleased to introduce Charlie Clark. So Charlie is the director of the Washington State Department of Financial Institutions. This is a position he has held since April 1st, 2019. He also currently serves as chair of the Conference of State Bank Supervisors. He first joined the Department of Financial Institutions in Washington in 2012, and prior to that, he worked in the Washington State Attorney General's office. And prior to that, he worked as an attorney in private practice. Charlie has served on the board of directors of the American Association of Residential Mortgage Regulators. He did that from 2014 to 2023, and serving as its president from 2018 to 2020. So please join me in welcoming Director Charlie Clark.
Thanks, Jim, and good morning. Welcome to the 12th Annual Community Banking Research Conference. As the chair of the CSBS Board of Directors, I want to also thank our co-sponsors, the Federal Reserve System and the FDIC. And I also want to especially thank our hosts, the St. Louis Federal Reserve Bank. This conference is a wonderful partnership. And I also want to thank everyone who is here or listening today. I know each of you has an interest in our nation's community banks. And this conference gives us the unique opportunity to bring together multiple perspectives from academics, regulators, policymakers, and bankers to figure out what is working and what is not working. As a state regulator, I have a vested interest in community banks being successful. We want our local economies to be prosperous. In some states, economic growth is a mandate for state supervisors. But in all states, it's important, and our community banks are a core component of our economic well-being. They fund 55% of small loans to businesses and 67% of commercial bank agriculture lending across the nation. However, despite their critical role in our dual banking system, community banks too often say that they are overwhelmed by regulations and supervisory expectations, and particularly concerned that those expectations are not tailored to their size, business model, or risk. This conference was born out of the too big to fail response that followed the global financial crisis in 2008 that presented the same concern. We realized we needed research on community banks to inform policymakers and reform our policy approach to this important sector of the economy. After the research from this conference, it has successfully joined data with anecdotes, and I'll give you an example. Community banks were critical when they provided much-needed loans to their customers through the Paycheck Protection Program during the pandemic. We gained more insight into just how essential community banks were to that program from the research presented right here in St. Louis. I think this is worth sharing, even if you've heard it before, because I believe community banks are facing a pivotal moment that needs our attention. Data shows that community banks are slowly disappearing in the current environment of costly technology and changing supervisory expectations. In fact, there are 1/3 fewer state-chartered community banks today than when we began this conference in 2013. So I want to boil down these numbers a little more. So in 2013, the United States counted 4,940 state-chartered community banks across the country. Today, there are only 3,321. That means that there are 1,619 fewer state-chartered community banks in the United States since we started this conference. I'm being specific here because clearly, especially in today's world, every bank counts. And we aren't getting many new ones. De novo activity is alarmingly low. So with only 45 new state-chartered banks since 2019, including only one formed this year, 2024. As a state regulator, the shrinking number of community banks concerns me, not because there's some magical number of banks that we have to have, but because of what their presence means. The decline in the number of community banks should concern all of us. We refer to these banks as community banks for a reason. They're the lifeblood of their communities. Community bankers know their customers' spending habits, they know their credit needs, they live in and support the communities that they serve, and they know their customers by name. They are the embodiment of relationship lending. And it's these localities that suffer when a community bank disappears or when they're acquired by an institution from outside of the community that does not understand the local economy. The former customers feel the loss most directly. So what's causing this decline? I believe several factors are at play. So, of course, community banks face market pressure. Competition is on the rise, and it's not just from depository institutions. Non-bank mortgage lending, for example, represents more than half of the mortgage market. Implementing new technologies can be prohibitively expensive. And banks' hands are often tied by their core providers, preventing updates and adoption of key new and innovative products or services. And yes, we're hearing that rapidly changing regulations and supervisory expectations are overwhelming community banks. This factor has been a consistent top concern in our annual survey and quarterly sentiment index for community banks. I asked CSBS to do some research, and they found some startling numbers. We estimate that there have been 30 proposed or final rules from the federal banking agencies totaling more than 4,000 pages for banks this year alone. Not all of this is directed at community banks, but there is also often a supervisory effect. In Washington State, we internally refer to this as a downward creep toward the smaller institutions. I fear that the volume of federal regulations is forcing community banks to spend more and more resources solely on regulatory compliance without an appropriate consideration given to tailoring regulation to risk and the size of the institution. As a regulator, I will always insist on safety and soundness and consumer protection. But I think we can accomplish these goals without a seemingly endless demand for more reporting and more personnel and more management and more process until these small banks can no longer shoulder the ever-growing regulatory costs. One consequence of these costs and the challenges is consolidation. In the past 5 years, 600 state-chartered community banks have merged or been acquired by other banks or credit unions. In my home state of Washington, 2 community banks have merged with banks based in other states in just the past 18 months, and another is pending. One more has been acquired by Washington State Credit Union, and we have 4 more transactions of credit unions buying banks in various phases of the application process. These transactions, credit unions buying banks, are something we're hearing about more and more nationwide. And we expect to see a few more in Washington State. But we can't blame the credit unions. In this environment, everyone must scale to survive. And the transactions make sense for many of the credit unions, some of which I have authority over. I think it's fair to ask if we are creating the very environment that is forcing these vital banks to close or merge. Are we adequately tailoring our regulations and supervision to the risks that these small institutions, most of them under $1 billion, pose to consumers and financial stability? We should be asking the fundamental question: what can we do to revise this trajectory? We need to step back and look at regulations to make sure they are targeted to the risks presented by community banks and their business models. We should embrace innovation in the system. We need to consider the benefits of new business models and innovative products and services. Our regulatory guidance must be transparent and provide clear operational direction that is, again, and this is important, tailored to the size of the institution and risks presented by the institution. We should not dismiss an application out of hand because the bank wants to try something new. As regulators, we must devote more attention to the success of third-party partnerships, particularly for community banks. We've seen the risks quite clearly. We have seen banks that branched out beyond their core business model and did not invest in the technology or personnel to effectively manage third-party partnerships. But due to continued decline in the number of community banks, the importance of scale to address regulatory and technology costs, and the competition from other financial service providers, we must provide clear guidance for community banks who need third-party partnerships to survive. And I would say who want to do it in a responsible way. In other words, we need to be transparent with our expectations and not keep moving the goalpost. That brings me to this conference and the work ahead of us. In the next 2 days, we're going to learn more about the impact of community banks on the local economy, deposit stability, and consumer protections. Our keynote speaker, Elizabeth McGinnis, will share her perspective on risks and opportunities for community banks to draw on their relationship lending models to compete. And the winning team of the CSBS Community Bank case study will share its research into community banks' use of social media and how it is preparing for regulatory and supervisory changes. I encourage all of us to listen closely to these findings and to engage in tough conversations throughout the conference. Let's find the pain points and let's work on solutions together. We don't want to lose another third of our community banks in the next 12 years. A competitive and diverse marketplace is important for consumers. They should have a number of responsible financial service options from which to choose, and this availability should help lower the cost of credit. We need to work together to make sure that community banks remain a viable option. State regulators look forward to working across the financial system to help make that happen. Thank you.